Watch this before Monday. Silver just triggered a signal most investors can't see. Silver just did something it hasn't done in 7 months, and almost nobody is asking why. On Thursday, the price dropped to its lowest level since December. Then, within 48 hours, it ripped back more than 5%. That kind of violent reversal doesn't happen because retail traders change their minds. It happens because something underneath the surface just moved. And once you see what actually triggered it, you'll understand why the signal, quiet as it was, matters more than almost anything else happening in markets this month. Because this isn't really a story about silver. It's a story about what the Federal Reserve just admitted, without saying it directly. The mystery. Here's the strange part. On the same week silver rebounded, the US government released a jobs report that missed expectations badly. Only 57,000 jobs were added in June, the weakest number in 4 months, far under the roughly 110,000 economists had forecast. 2 prior months were revised down by a combined 74,000 jobs. That's not a rounding error. That's the labour market quietly cracking. And by the time we reach the end of this video, you'll understand why a bad jobs report and a silver rally are actually the same event, seen from 2 different angles. Most investors look at silver's bounce and think, relief rally, nothing more. We're going to look at what's underneath it, the mechanism connecting a weak labour market, a Federal Reserve chair choosing his words with unusual precision, and a physical metal market that may already be sending a signal the paper market hasn't caught up to yet. There's a reason the mainstream coverage stopped at silver rallies on rate cut hopes. Stay with me, because that headline is true, and it is also nowhere close to the whole story. Context. To understand what just happened, you need to understand how silver actually trades, because it is unlike almost any other asset on Earth. Most of the price you see quoted comes from COMEX futures contracts in New York, each representing 5,000 troy ounces of silver that, in the overwhelming majority of cases, never physically changes hands. Traders roll contracts forward, settle in cash, and the metal sits in vaults, largely undisturbed. This is what's often called paper silver, a financial claim on silver, layered many times over on top of the physical metal that actually exists. Then there's the other side, physical silver. Coins, bars, industrial-grade metal that solar manufacturers, electronics makers, and defense contractors actually need in hand to build things. That market moves on entirely different logic: supply, delivery schedules, vault inventories. For most of modern history, these 2 markets, paper and physical, have moved together closely enough that nobody worried about the gap. What we're about to look at is a moment where that gap started to matter. Because in May of this year, something structural happened that barely made headlines outside specialist circles. The hidden layer. On May 22nd, the ABAX exchange in Singapore launched a new kind of silver futures contract, one built specifically around physical delivery. Unlike a typical COMEX contract, this one is a 1,000 troy ounce, dollar-denominated instrument that requires actual delivery of silver refined to 99.99% purity into approved vaults in Singapore, including Brink's facilities. That purity level isn't arbitrary. It's the exact standard demanded by solar photovoltaic paste manufacturers and semiconductor fabs across Asia. The industry is actually consuming silver at record rates, not trading it on margin. What institutions actually do is quietly different from what they say publicly. And what a physically deliverable contract does, one traders can't simply roll over in cash, is force a more honest accounting of how much real silver exists versus how many paper claims are stacked on top of it. This is the smart viewer thread we'll come back to. For now, hold on to this. A new delivery-based market just opened in the exact region where the real industrial demand lives. That's not noise, that's infrastructure being built for a world where physical settlement starts to matter more than it has in decades. But that's only half the story. The other half comes from Washington. Escalation. This week, Federal Reserve Chair Kevin Warsh spoke at the ECB forum in Sintra, Portugal, and said inflation risks have come down. On its own, that sounds like reassurance. Paired with a labor market that just delivered its weakest quarter of job growth in roughly a year, it reads very differently. Markets immediately repriced the odds of a September rate hike from roughly 2/3 likelihood down to close to a coin flip. A weaker labor market and a Fed chair signaling comfort with cooling inflation both point the same direction, toward lower rates, or at least no near-term hikes. And lower rates reduce the cost of holding an asset like silver that pays no yield. That's the mechanical explanation. Here's the second, connected, dynamic, most coverage missed entirely. A weakening dollar. The dollar posted its steepest weekly decline since April during the same stretch. Silver, priced in dollars globally, becomes cheaper for buyers holding other currencies the moment the dollar softens, adding a second tailwind stacked directly on top of the rate expectation shift. Two forces arriving in the same 72-hour window, both pushing the same direction. That's not coincidence. That's convergence. Historical parallel. Now, this is where the story changes completely, because we've seen this exact convergence before, and the outcome wasn't subtle. In August 1971, President Nixon closed the gold window, ending the dollar's convertibility to gold. Most Americans didn't understand what had happened. Within a decade, the US experienced double-digit inflation, and the price of both gold and silver rose by an order of magnitude, as confidence in the dollar's underlying anchor eroded. The pattern wasn't really about a single announcement. It was about a slow erosion of confidence in monetary stewardship, followed by a scramble into hard assets once the erosion became undeniable. Look at where we are now. A Federal Reserve chair signaling comfort with disinflation odds, even as labor data weakens. A dollar under pressure, and quietly, in Singapore, a new physical settlement mechanism coming online for the exact asset that becomes attractive when confidence in paper claims starts to fray. Sound familiar? History doesn't repeat with a script, but the underlying psychology, currency stress meeting physical scarcity, has a way of rhyming. Present-day implication. Bringing this back to today, silver has traded in an extraordinarily wide range over the past year, from an intraday low in the mid-30s to highs above $120, before settling into the low to mid-60s as of this week, a level still roughly 60 to 70% higher than a year earlier, despite the recent pullback from that peak. The gold to silver ratio, a figure watched closely by institutional desks, compressed to around 66.5 during this same window, meaning silver has been outperforming gold on a relative basis, even during a period when gold itself hit record highs above $4,100 an ounce. Central bank gold accumulation has continued running net positive through the first half of this year, according to industry newsletters, a sign that official institutions, not just retail investors, are hedging against currency uncertainty. Silver historically follows gold's macro tailwinds with a lag, then moves faster once industrial demand data confirms the trend. If current conditions continue, a Fed leaning dovish, a softening dollar, and a physical delivery infrastructure expanding in Asia, the setup for silver looks structurally different than a simple commodity bounce. Future scenarios. So where does this go from here? A few conditional paths, not predictions. One scenario. If the Fed confirms a rate cut path later this year and the dollar continues weakening, silver's recent rebound could extend as more capital rotates out of cash equivalent assets into hard assets, mirroring the pattern from prior dovish pivots. A second scenario. If the labor market stabilizes and the jobs miss proves temporary, the Fed may hold rates steady longer than markets currently expect, and silver's rally could stall or partially reverse. A reminder that this metal remains genuinely volatile in both directions. A third, more structural scenario. Regardless of near-term Fed decisions, the gradual build-out of physically deliverable markets like ABAX's Singapore contract could slowly shift pricing power away from paper markets and toward regions with the heaviest actual industrial consumption. A multi-year shift, not a one-week trade. Historical precedent suggests currency-driven metal rallies rarely move in a straight line. The evidence begins to point toward a market in transition, not a market with its outcome already decided. The Smart Viewer section. While most retail investors are watching the daily spot price and reacting to headlines about silver rallies or silver crashes, the pattern underneath is a slower, structural one. A widening gap between how silver is priced on paper and where the physical metal is actually needed and delivered. The people watching this video to the end are not average investors reacting to a single day's move. You now understand that a rate decision, a jobs report, a Fed chair's word choice in Portugal, and a new vault contract in Singapore are not four separate stories. They're one story, told from four different rooms. That's the difference between reacting to price and understanding what moves it. So go back to where we started. Silver hit a 7-month low, then reversed hard within 48 hours. That reversal wasn't random. It was the visible surface of a Federal Reserve chair choosing careful language, a labour market cracking faster than expected, a dollar under pressure, and a physical delivery system quietly expanding in a part of the world where silver isn't a trade, it's a raw material. The question worth sitting with isn't whether silver goes up or down next week. It's this. When the gap between paper claims and physical metal finally gets tested, which side of that gap do you want to be standing on? This video is for informational and educational purposes only and does not constitute financial, investment, or trading advice. Precious metals prices are volatile and can move sharply in either direction. Past performance is not indicative of future results. Always conduct your own research and consult a licensed financial advisor before making investment decisions.